Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate jargon and numbers so you don't have to get ready, because today we're diving into the latest filings from Shelton Funds, a company that manages a whole bunch of investment funds. And let me tell you, there are a lot of numbers here that might make your head spin, but we'll break it down. This past year has been a rollercoaster for the markets, and the Shelton funds are showing us how different types of investments have weathered the storm. We'll look at their year-ending reports for August 2025 to see their performance costs and what exactly they've been investing in, whether you are an investor or just curious about how these things work. Stick around. Also, before we get into the nitty-gritty, if you love breaking down corporate filings and getting straight insights, make sure you are subscribed. We also have a fantastic Discord community linked in the description below where we discuss these reports, and more so, come join the conversation. Alright, so this document is essentially a yearly checkup. For Shelton Funds, it gives us a look at several of their different investment funds like the Green California Tax Free Income Fund, the US Government Securities Fund, and several index funds like the S&P 500 Index Fund and the NASDAQ Negative 100 Index Fund. They're showing us how these funds performed over the last year from September 2024 to August 2025 and how much it costs to invest in them. Let's peek at the costs for the Green California Tax Free Income Fund Investor Class. The cost for a hypothetical $10,000 investment came in at $82, which is 0.81% of that investment. That is not too bad for a year's worth of management and fees. It's like paying a small dollar fee for them to manage your money. Now, what affected their performance? For the Green California Tax-Free Income Fund specifically, it seems like the municipal bond market, or muni market as they call it, had a rough patch, especially around April. Yields, which are like the return you get on your investment, went up and down quite a bit. Apparently, a Liberation Day event really shook things up, causing losses in the muni market. Even though riskier investments started to recover, municipal bonds didn't fully bounce back as much, limiting their strength. The report says the fund's returns trailed the muni market index because it was shorter in duration, meaning it holds bonds that mature sooner, and that hurt returns when things got volatile. Plus, their portfolio was higher quality, meaning they invested in safer, but maybe less exciting options that didn't do as well in the rebound. Looking at the cumulative performance for Green California Tax-Free Income Fund, if you had put in $10,000 back in August 2015, by August 2025, your investment would have grown to $11,080. That's about a 10.8% growth over 10 years. However, comparing that to the Bloomberg US Municipal Index, that same $10,000 would have grown to $12,405. So the fund slightly underperformed its benchmark index over the long term. Moving on to the US Government Securities Fund Investor Class, the costs were a bit lower at $77, or 0.76% of a $10,000 investment. This fund focuses on government bonds, which are generally considered safer. What affected its performance? Well, the government bond market has been pretty jumpy, especially since inflation went up in 2022. This year was no exception. Trying to guess when the Federal Reserve would cut interest rates caused a lot of ups and downs. The 10-year US Treasury yield, a key indicator, actually rose over the year. There was some volatility around Liberation Day too, with proposed tariffs causing a temporary flight to safety for treasuries, but yields climbed back up. Interestingly, shorter term treasury yields fell a lot, while longer term yields rose. This curve inversion, as they call it, is a bit complex, but it means investors were demanding more return for holding onto longer bonds. For the US Government Securities Fund Investor Class, a $10,000 investment from August 2015 would have grown to $10,643 by August 2025. That's a gain of about 6.4% over 10 years. Now, compared to the Bloomberg US Aggregate Bond Index, that same investment would be worth $11,949. And compared to the Bloomberg US Treasury Index, it would be $11,242. This tells us that this fund significantly underperformed both its aggregate bond and treasury benchmarks over that decade. The report mentions that the fund's overweight position in longer dated bonds, like 20 and 30-year bonds, was a drag on returns. Scroll costs of a $10,000 investment S&P 500 index fund. Investor class return next up, the S&P 500 index fund. Investor class carrying costs of $43 or 0.42% on a $10,000 investment. This fund aims to mirror the S&P 500, so it is all about tracking the performance of the biggest US companies. What made this fund tick? Believe it or not, the information technology sector was the biggest winner, contributing over 22% to the fund's total return. Semiconductors and semiconductor equipment were particularly strong, up over 37%. Communication services was also a big player. On the flip side, healthcare was a drag, down over 11%, with pharmaceuticals taking the biggest hit. As for individual stocks, Nvidia, Microsoft, Broadcom, and Meta were the stars, with Nvidia alone adding over 45% to the fund's return. However, some big names like United Healthcare Group and Eli Lilly also pulled the fund down. If you had invested $10,000 in the S&P 500 index fund back in August 2015, by August 2025, it would have grown to $37,696. That's a fantastic return of over 270% in 10 years. And guess what? The S&P 500 index itself did even better, growing that same $10,000 to $39,076. This shows the fund did a pretty good job of tracking its benchmark index, which is exactly what it is supposed to do. Now, for the NASDAQ Negative 100 Index Fund, investor class costs were $53 or 0.52% on that $10,000 investment. This fund tracks the 100 largest non-financial companies on the NASDAQ exchange, so it is heavy on tech. And guess what drove its performance? You guessed it, information technology. It was the star performer, up over 22%, with semiconductors leading the charge. Communication services also did well. Healthcare, though, took a hit, down over 9%, and consumer staples lagged, dragged down by food and beverage companies. Top performers included Broadcom, Nvidia, Microsoft, and Tesla, with Nvidia alone boosting returns by over 45%. However, Adobe, Regeneron, and even Apple, despite being a big part of the index, acted as detractors. Let's talk numbers. That hypothetical $10,000 invested in the NASDAQ Negative 100 Index Fund back in August 2015 would have ballooned to $56,566 by August 2025. Compare that to the NASDAQ Negative 100 Index itself, which would have turned that $10,000 into $60,247. The fund slightly underperformed its benchmark, but it is still a massive growth over 10 years. Looking at the S&P 500 Index Fund's key fund statistics, its net assets were a whopping $297,934,113 as of the 31st of August 2025. They paid out $705,307 in total advisory fees. That is a significant chunk, but for managing nearly $300 million, it is understandable. The low portfolio turnover rate of 10% suggests a buy and hold strategy, which is typical for index funds. Now, for my take on Shelton funds, overall, they offer a range of funds from specific indexes like the NASDAQ Negative 100 and S&P 500 to more niche areas like municipal bonds and sustainable equity. The index funds, as expected, closely track their benchmarks, which is good news for investors who want market matching returns. However, some of their actively managed funds like the Green California Tax-Free Income Fund and the US Government Securities Fund have lagged their benchmarks over longer periods. This is something to definitely consider if you are looking at those specific funds. The costs, especially for the K-class shares, are a bit higher, which is common for institutional share classes. But it is always something to compare. The Shelton Equity Income Fund, despite some sector headwinds, showed strong performance, particularly in the last year, which is a positive sign. The inclusion of detailed sector and top holdings information is helpful for understanding where the money is actually going and what drives returns, like the heavy weighting in technology for the NASDAQ Negative 100 Fund, which is a key driver of its high growth. The biggest risk for all of these funds, as the reports often mention, is market volatility. For the index funds, it is about tracking error, meaning how closely they follow the index. For the others, it is about individual security performance and broader economic trends. The ongoing trend of interest rate changes and inflation will continue to shape the performance of all these funds, especially the bond funds. In conclusion, Shelton Funds offers a diverse portfolio, with their index funds performing as expected and some actively managed funds showing mixed results over the long term, but potentially offering opportunities. It's always a good idea to look at the specific fund's objectives and compare its performance to its peers and benchmarks before investing. Alright, that is our breakdown of Shelton Fund's latest filings. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.